financial journey, the August investor update. I'd like to take a moment to welcome all of the clients who attend regularly, and then some new clients who are joining us now, as well as guests that have had time to come and hear what we have to share this month, August, in the investor update, and how this is all impacting your financial journey. For today's program, For today's program, I just want to remind you that we're going to be covering estate design issues, which quite honestly have a lot to do with legal matters. And I would point you especially to this section right here that neither myself or our firm are attorneys or CPAs. We've done a lot of work in this area with helping clients to work with their legal and accounting professionals, but we are not those people. So whatever I share today, please take this information and review it with your accountants, with your attorney to help put together your estate design or estate plan to make sure that fits for you. Additionally, we will be talking about market and economic issues. So as always, take that information and blend it with everything else you have to make sure that it makes sense for you, that it accomplishes what works for your needs, whether that be for income, capital reserve or cash reserve, growth, protection of principal, etc. Make sure that all of these items make sense for you. As always, we want to... Hello. I think that may be the first time I've ever had that happen. Well, at least first time since doing this. Anyway, we want to make sure that the disclosures, they mean something to you, that you make sense of them as it relates to your situation, because no one idea works well for every person. We will take time at the end for questions, although I will tell you that I have a lot of information today. I actually thought about breaking up the estate design discussion into a third part, but I decided we're going to go ahead and go through it, and then I'll share with you how we're going to handle it in the future, maybe to make it so it's even more valuable for you. But we will try to take time for questions at the end, so please feel free to make note, and you can either raise your hand or chat whatever questions you have, and we'll take time to go through that. Today, we're going to do a quick market and economic review. I've got some really great, I think, in my opinion, updated information to share with you. We're going to talk about how that relates to your portfolio management diversification and how you're considering what options to do. We're going to take a look at understanding the power of wealth transfer planning, the second part of that discussion from last month. Then we're going to take a quick look at the wealth management apps that are available to you. Take time for your questions, and I'll remind you of the next updates we've got coming up, because there's a couple of changes coming up in the next couple of months. So the good, the bad, and the ugly, I've been sharing lots of information, but I think the real question comes down to these three questions here. Are we in a recession? Are we experiencing stagflation? And what's next? Well, depending on where you get your news, you may or may not think that we're in a recession. As long as I've been in the industry, which is over 3 decades, a recession has always been counted as 2 quarters of negative GDP growth, which we have had. So technically, from my viewpoint, we are in a recession. I would point out quickly, though, that it is a very shallow recession. It is not a very deep recession at all. We're just barely at 1% in negative growth, but it is negative nonetheless. So we have a recession, in my opinion, even if the administration doesn't want to classify it as that. But I would support the idea that it is a very shallow inflation, and so therefore that's important. How shallow the recession is and how long it lasts are two very critical pieces, because not all recessions are created equal. Are we experiencing stagflation? Well, I would say that by the answer to the first question, the answer is we are. Inflation certainly has been an issue. I was talking with just one of my clients just earlier this week, and they were telling me that their business costs have increased 62% from over a year ago. I say that definitely counts as inflation. And the average person, when it comes to just simply purchasing food and fuel for the house and electric for their house, etc., clothing, all of those have seen increases. So I would definitely say that our economy is stagnating because we have a shallow recession and we are experiencing inflation still. So it probably is reasonable to say that we are experiencing stagflation. But as I would point back to the first question, it is a very shallow recession, and so far a short recession. We shall see how long this goes on. But at this point, I would say, yes, we are experiencing stagflation. And those two issues should play into the rest of our discussion today, at least as it relates to the markets and the economy. Which now brings me to the third question, which is what's next? And nobody knows what's next. And we're going to take a look at some ideas of what might be coming down the road, but I would be the first to point out that there have been many times I thought one thing was going to happen, that something different happened. But at the same time, there have been many times that I've been able to identify opportunities or at least changes we should make based on what we see, not because I can read the future, but rather because you know, history maybe doesn't repeat itself, but it does rhyme a bit. There are some similarities during different times. So hopefully that will be the same here in this discussion as well. If I were to point at what I consider to be the 4 economic engines or engines of economic growth, I would say that now we're looking at GDP growth, Q1, Q2 as both being negative. So I would clearly call this a minus right now. So that engine's not doing as well. Business profitability is up in many quadrants, but it is also down in many other quadrants. So I would give that a plus minus right now. Unemployment rates are still low. Matter of fact, there's a real urgency to get more people into the employment market. So quite honestly, that is an issue, but I can't deny the fact that unemployment rates are clearly low. So we give that a plus. Interest rates are still very low, so that makes it a plus, but because they are raising them, it makes it a minus. So I would say it's a plus minus at this point. The Fed has made serious efforts to try to raise interest rates more aggressively at the beginning, hoping that they won't have to raise interest rates more down the road. And if they're successful at that, that would turn this engine into a plus. And so one engine's probably shut down right now, in my opinion. The other 3 are running, one at peak performance, the other 2 kind of at moderate performance. So the US economy is still flying and it is still strong in many ways, but it certainly has some challenges right now that it's dealing with. So in understanding what I'm about to show you, I want to remind you of something that I've talked about in previous times, and that is how we look at managing portfolio drawdown, meaning when your account goes down. The reality is there's 2 models out there. One is a buy and hold mentality, which certainly I don't have a problem with. I think it has a place and it can be a strong place. And historically, it's been a good strategy if you have long-term ability, meaning you don't need to access money anytime soon. But I would also suggest that a grow and protect model could be just as vital. It certainly is not a quick trading process, not day trading, but it's more of a trend trade, trying to understand when the cyclical nature of different investment options is at a peak or a trough. And the reason I think managing that drawdown is critical is about what I'm about to show you, which is first off, understanding that if your portfolio falls from 100,000 by 25% down to 75,000, to get back up to that line again where you're at 100,000, it takes a 33% return because you are starting from a lower position. You're getting 25% on 75,000, which isn't going to bring you back up to 100. It takes 33% to get back up at that point. If the portfolio drops 40%, it takes a 66% rate of return to get you back up to 100%. And if the portfolio falls 50% from 100,000 to 50,000, to get back just to even again, it takes a 100% return for that to happen. And that's why I think that if we can manage drawdown, meaning if we can minimize when it's down, if we can make adjustments when we haven't lost so much, it's a smaller hole to climb out of. And with that in mind, it means that we can then have more money to move to more conservative positions with. And then when the market turns, which it surely will, that then gives us the ability to have more money to invest back in that market, making it so it's easier to climb back out of that hole instead of trying to follow it all the way down, just live with it and then follow it all the way back up, by being a little more proactive and taking advantage of opportunities when they exist, either of selling at an appropriate time and then buying back in at an appropriate time. And appropriate, it's as much art as it is science. And trying to figure that out is one of those issues that we work hard to do. That's why I do these monthly updates to share with you what I see happening so that you are certainly involved in this conversation and can help us to understand how this works for you. Now, what you're looking at is the chart that I showed last month. I kept it on here because I wanted you to see on the S&P 500 right here where we were before. This blue line is the 200-day moving average, and this daily activity here is below the 200-day moving average. With that in mind, let me show you where we are today, because the reality is what I thought would happen has happened much faster than I expected. What you're looking at now is the S&P 500. Again, this is roughly where we were before. And you can see from last month to this month, we are almost up to the 200-day moving average. I really, when I had the investor update with you last month, did not expect to be this close to the 200-day moving average. As a matter of fact, if I pull up the Dow Jones, we're actually in excess of the 200-day moving average. And with that in mind, that means that we have had a lot of growth in a very short period of time. If I also put on inspect here so you can see the lines. So this again is the high back in January 4th, where we were before. And you can see that in relationship to where we are today. So we were at 40, it looks like 48, 48.06, 48. No, I'm sorry, that day we closed at 47.93. And today we're closing at 43.05. No, those numbers are hard for me to see, but 43.05, which means that we are now we are better than 10% or less than 10% down from the high of the S&P 500. And for many of your accounts, that means that we are even better than that, because many of you aren't invested fully 100% in an aggressive portfolio that matches the S&P 500. So with that in mind, what that means is that this point in time represents an opportunity to determine, do we make an adjustment? Back in January, when the market started to turn down, there were concerns, but in reality, you can't just jump at the drop of a hat. You got to have some plan. You got to have an entry and exit strategies you've heard me talk about before. When we broke through the 50-day and then down through the 200-day moving average, came back up, hit off of it, and then turned and went south again. That certainly, as we've moved into March, made me think that there probably is something more going on, especially as the talk of inflation and a stagnating economy were beginning to grow. Those items began to really play heavily into this. Additionally, I would say that when we looked at that experience as in related to the first negative growth in the GDP during Q1, made me think that maybe there were some more problems. And that certainly served to be true. But by the time we came to that conclusion, we had already dropped down here. And so I hate to sell out in the bottom of the market. And when I say sell out, I mean move to more conservative positions, to take our current proceeds and move them more conservative positions, especially if I think there's a chance for the market to come back. And obviously, I've told you the last few months, I did think that was happening, and I do think that's the case. Now, something I want you to note that is different from last month to this month is, notice here, this little bump up and then turn down and take back off again. I want you to notice, if I come clear back here, see how that gray line goes all the way across? Because what that means is when it comes down and it's above that line and hits that point, that means and it turns around and goes back up again, as you can see here, for instance. When it does that, that means that the buyers are taking over. They're actually moving in and buying into the market again. And when it goes south, the sellers are taking over and they're selling out of the positions. And when you see this here, what happened most recently up in here was another one of those demarcation points where the buyers and sellers finally came to a conclusion. And in this particular case, the buyers took over the battle. They actually are moving up higher and higher. Now, the question then becomes for all of us, does this mean that we're done? It's okay, everything's good again. I'm not sure of that, because as I said before, once it hits the 200-day moving average, this red line right here, I think the question is going to become, will it break through it? If it goes above it, will it stay and hold and then continue on up again? Or will more heavy news about inflation, a stagnating economy, supply chain issues, as we move towards the end of the year here, will those items, maybe reduced Christmas sales or something of that nature, will those items continue to plague the market and make it go back down again? So that's what we're watching for very closely here, because this is, much like I've done in previous times, this point right here is where I feel like we have gained back a lot of what was temporarily lost. And if it looks like we're not going to be able to hold this, that's when we would move you back to more conservative positions, at least until this was over, which could be another 6 months, it could be another 9 or 12 months. It really, there's many factors that we have to watch, all of us, you and I included, to make sure whether or not this is that exit strategy, or if this is just another opportunity to take advantage of more growth. Again, by this time next month, when we do our next update, I'll have more information for you, and we can hopefully have even seen some opportunities of either A, it's continuing on, it converges and then diverges, then moves into an upward position, upward trend again. But if it hasn't, we'll probably be having a different discussion and talking about how the economy may be more problematic between now and the end of the year, and maybe taking advantage of those opportunities by getting more conservative and then looking for items that make money during those types of investment environments. So we're at this place today where I would say to you, it's really important that we watch carefully what's going on and make some good decisions in the process. With this in mind, we'll probably be able to have a more complete discussion, I suspect, by next month at the same time. Again, as always, if you have any questions about what we're doing here, as specifically how it relates to your portfolio, as always, I'm available for you. We'd be happy to answer that and talk in detail what makes more sense for you. If you would like to look at other opportunities, we've got that taken care of. Let me pull this back up here again. There we go. Because the reality is what we want to do is make this so it works best for you, which means that our options are the same as they were last month. One, we could utilize assets or securities that correlate opposite or negative to the overall equities market. I'm glad we didn't do that for the majority of you since the last month, because we've seen a very nice uptick that has benefited your portfolios a lot. Number two, we could adjust the portfolio to more conservative positions. And we could do that right now, immediately, to protect against further portfolio erosion. That's certainly another option. Since last month, a few of you had done that, and we're happy to do more of that if you want to, but I prefer to wait until we see a little more information before we take that action, make that change. Or number three, we can continue reviewing the fundamental and technical analytics and adjust the portfolio to more conservative positions if/when the fundamental and technical data supports that adjustment. And again, that assessment of when that supports that decision is a choice that I'll make. But at the same time, if you would like to have more conversation about that for you, I'd be happy to have that conversation as well. So what we look at here, as always, is diversification of the portfolio, trying to have the right amount of cash reserve, more conservative investments, more aggressive investments for growth oriented, taking a look at particular sectors and industries that are doing better, looking at that, how it relates to your overall portfolio to meet your cash reserve needs, your income needs, your growth desires, your risk tolerance, all of the critical points that make it so you can feel comfortable to stay invested long term. And then take advantage of those needs, make sure that your needs are met so you can take care of your family's financial needs both today and in the future. As always, the goal is the same, to be proactive wherever possible and reactive whenever necessary. And I feel like we're in a very good position to be proactive as we look forward over the next couple of months. Now, as I shared with you from our last discussion on wealth transfer planning and estate design, I shared this with you before. The truth is, we will all die. We will likely die at a time we don't anticipate. We can't take any of our stuff with us, and someone else will get our stuff. It's smart to decide before we die who's going to get our stuff after we die. And that's part of what wealth transfer planning is. I reminded you that in your wealth management dashboard, for those of you who are using it, we have the ability to do calculations to say, what does your estate design look like? How much does it cost? How will it work? So that way you can make some great decisions going forward, how to minimize taxes now and in the future, and then even at the time of transfer to your loved ones, to make sure that they receive as much as possible, and that the IRS and the court systems and other financial firms don't end up with more money than they should, that the bulk of it goes to the people you love and care for. And so when we took a look at Mary and Harry Arm, we identified was the estate and then the costs that were associated with that estate. And then I said to you, part of my goal, which we're going to talk a little more about today, is to say, how do we fix those numbers? Because that's a lot of money, 2.7 million, almost 2.8 million going to taxes and court systems. It's a lot of money that I think could be better used for your loved ones, family, charity, et cetera, that you care about. So that's part of what the wealth transfer plan is about, is how do we make the most of taking care of family and those you care about, and then how do we minimize what goes to the other organizations. The wealth transfer process, while you don't have to be an expert on it, your attorney and your accountant and your financial advisors should be part of that counseling process. You do need to understand the transfer priorities. You do need to become familiar, at least, with the legal terms, the basic tax rules, and the tools that are available to help you create the best wealth transfer plan possible. You would have to take time to gather necessary information and data. And for those of you, again, using the wealth management dashboard, you've already done that. For those of you who haven't done that, this is your opportunity to gather that necessary information to create the best wealth transfer plan possible for you and your family. And clearly, once you've done all that work, you need to seek competent counsel to help you put that plan in place to accomplish your long-term goals, both while you're accumulating assets, while you're distributing or decumulating assets, and then when you transfer those resources to the next stewards. I shared with you last time the 4 P's of your wealth transfer plan: the people, the property, the plans, and the planners, and the 6 decisions that you have to make as you create your wealth transfer plan. And in the last webinar, what it did is we got through people, number 1, and we got through decision 1, transfer, and decision 2, treatment. So going forward, we're going to finish out the rest of those goals today in wealth transfer planning part 2. So just as a reminder, you and I, each of us, we have 6 assets for us to own, control, and use. And they represent household goods, personal property, personal effects, checking, savings, cash reserve, etc., investments and retirement plans, our residence, real estate that we have outside of our residence, commercial property if we own real estate that's for businesses, life insurance, trusts, family limited partnerships, all kinds of items that can be helpful in transferring wealth wisely. And then for some of you, you own businesses, maybe they're S Corps, C Corps, professional corporations, or LLCs. All of these assets you and I would hold, or at least some of them anyway, and we only have 3 aspects of them: what we own, what we control, and what we use. And recognizing that by maintaining control and use, we can do that while giving up ownership by placing assets into specially designed trusts. Because see, with ownership comes the following items. 1, taxes to pay. If you think about it, if a person doesn't own anything, they don't have to pay any income taxes. They don't have to pay any capital gains taxes. They don't have to pay any estate taxes. But with people who own a lot, they do have to pay those taxes. So having the right kind of account set up, the right kind of specially designed trust set up, you can actually eliminate or at least significantly minimize those taxes. Additionally, there's the challenge of the 4 Ds. What happens to property in the event of death? What happens to property in the event of divorce? What happens to property in the event of financial disaster, credit issues, financial challenges, etc.? And what happens to the property in the event of desertion from caregivers? There's certainly many elder abuse stories where people have brought people into their lives to help them as they got older, and they had those people take advantage of them and then desert them. When you don't own anything, then death, you don't have any assets to deal with at death. When you don't own anything, divorce can't have that division of property in that sense. Financial disaster, again, to those who don't own anything, it's a non-issue for them. And if there's nothing to take, then desertion becomes irrelevant. If there's income, and that's really a huge difference between assets and income. If there's income, it can be used differently and maybe in some ways better than what assets can be. But giving up ownership is a very hard thing to do. And so as we look at some of the items in today's discussion for wealth transfer planning, it represents a thought process of beginning to say, how do I maintain control and use of assets, but adjust ownership to minimize taxes and to minimize the challenges of the 4 Ds? So when we look at that, we now move to the 3rd decision, which is timing. Still looking at people and recognizing that really we have 4 choices on timing. Choice number 1, we could do an immediate distribution, or we could do a deferred distribution. We could do immediate while we're alive, or we could do immediate at the time we pass. But we can also defer it. We can defer that payment out and break it up into different lump sums or periodic payments and do that over a period of time. We can do a combination of the 2, some immediate, some deferred, some as lump sum, some as periodic payments. And then finally, conservative or liberal distributions. And I'm not talking about a political discussion. Conservative means it's very defined, it's well identified, no room for changes. More liberal distributions mean you have more opportunity to adjust it, or your heirs or donees have opportunity to adjust the payment based on certain criteria identified in your trust or your various accounts. That timing is very important because, again, some of the people that you're going to leave resources to, they're ready to handle it now. They're fully trained for it. They're ready to go. And others, maybe not so much. And so having a good process in place to decide who should get what and at what timing model can be critical to developing a wise wealth transfer plan. Now we take a look at decision 4, titling. And now we move from people to property. The first 3 decisions were about the people and trying to match up what we have in our families and the people we're leaving resources to, and to create the best way for transfer, treatment, and timing. But now as we move on to property, we now begin to look at the second P and say, so what are we doing here? So the first issue is, what type of property are we dealing with? Are we dealing with cash assets? Are we dealing with real estate? Are we dealing with a business? Are we dealing with some type of trust account? How is that titled? In essence, who's the owner of it? When was it purchased? What is its cost basis? What is its present value? Those can figure into tax consequences, either of selling before you pass or advantages because of what's called step-up basis after you pass. And having a good plan for that property and the titling of it can help you set up a much more efficient wealth transfer plan. Now we move on to decision 5, which connects to number 3, the third P, plans. So when you're putting together the various tools and techniques, and I think that becomes a discussion. Honestly, when I talk with people, I find that everybody wants to jump to number 5. Well, what are the plans we're going to do? We're going to set up a revocable living trust, or we're going to set up a will, or we're going to set up a charitable remainder trust, or a Q-tip, or they're all focused on the tools and techniques. And that's why these first 2 principles are critical. 1, techniques accomplish your objectives. They are not the objective. And never use a trust because of lack of trust. Now, granted, sometimes you'll use a trust because you're trying to help somebody, but don't do it from a negative viewpoint. Do it from a positive viewpoint. How do I create the best distribution model? You have a child who's not the best money manager, or maybe they have some behaviors that put them in danger. You're not using the trust because you don't trust them. That may be one result of it, but my encouragement is think of what is the best way to help them to achieve what they need, to protect against those 4 Ds, and to be able to accomplish the goals that you feel called to help them achieve once you're no longer here to help them with that. So if you have these 2 principles in mind, you can then begin to really start thinking through the process of what kind of trust or what kind of tools and techniques I should be using. So 2 trust management ideas. 1, place the property under third-party control. Irrevocable or revocable. Irrevocable means that once it's set up, nobody can change it. But revocable or revocable means you can change it, or even your donors can change it, or they can change pieces of it. And when you talk to your accountant, or I'm sorry, your attorney, what you want to do is talk to them about which one makes more sense. And in some cases, you can even set up some programs that are irrevocable, and then you can set up others that are revocable. They could be changed along the way. Again, depending upon what the needs are of the people and the organizations you're leaving resources to, should have a big impact on how you want this to look. Again, don't let the tool or the technique be the objective. Identify what your objectives are and then choose the tool or technique that best suits that. Number 2, utilizing incompetency provisions. You know, I'm not going to get much opportunity to talk about end of life issues which have to deal with incapacitation or incompetency. But the truth is, most people think of their estate plan, their estate design, as being about death. And it is true, that obviously is a big piece of it. But long before that happens, there are health issues. The majority of money that people spend on healthcare happens in the last year of their life. The inability because of incapacitation to be able to handle certain things, or because of incompetency, Alzheimer's or dementia, make it very hard to make some of these decisions. And so while you're thinking of you, for instance, or your spouse, as you're trying to think through, well, how would I set this up? Recognize that the next people who are going to receive these resources, these assets that you've been stewarding, they may have a similar issue. And for some of them, you might say, they've got it under control, they can handle it. But for others, you might say, you know, I need to think through what happens if there is something that isn't working as well when it comes to incapacitation or incompetency. to make sure we create the best outcome to achieve the objective that you're looking for. Another idea when it comes to planning is capital conversion planning and business succession planning. And when I take that, I'm going to share this with you. One, when we're looking at transferring a family business, I just want you to think in terms of this. Identifying ownership thinking versus leadership and management objectives is critical. Over the decades I've been doing this, I've seen families come in, I've seen families who own the business, who pass it on to heirs. I've seen heirs who didn't want to manage it, but didn't know how to explain that. I've seen heirs who, some of the children wanted to manage it, some of them didn't, and I've seen challenges in that discussion. I've seen people that were left businesses that really weren't ready for it. They hadn't been trained and it wasn't their strength. And so consequently, it ended up becoming a much less valuable asset. So my encouragement is if you are transferring a business, then recognize that it's wise to identify ownership thinking versus leadership and management objectives. Don't assume just because you can manage and run a business that your kids can, because they may or may not be ready for it. And if they're not ready for it, either A, help them get ready for it if they want to, but if they don't, then identify a way to transition that, to create a business succession strategy that works well for the asset itself, but more importantly, for the family as well. Clearly define the purpose of compensation for heirs receiving ownership in the business. Again, you may have some children that want to run it and some who don't, and identifying up front what the purpose of the compensation is, how you're setting it up, and how the ownership is going to be set up, so that instead of having the children fight each other, they actually understand what your plans were and it makes sense for them and it works well for everybody, so that your children are stronger together than they were without this thinking in place. Think long term, because in reality, I talk about it in sort of a what if it doesn't work out well, but what about this? What if the business becomes extremely valuable 20, 30, 40, 50 years from now? How do you want that handled? That's why thinking in terms of compensation and ownership in the business is critical for how this is going to impact those who want to be part of it and those who don't. And obviously the other side of it is, what if the business becomes worthless? What's going to happen then to those who are counting on it? Will that create challenges between heirs when one child couldn't run the business well enough and it fell apart and the other children are angry? Again, thinking through that process is absolutely critical when you're looking at business succession planning. And I would then say even to the point of conversion planning, because it's important to understand the last point. Cash is easier to transfer than property, and property is easier to transfer than a business. Because with cash, it's liquid, easy to use, easily accessible. With property, it can be incredibly valuable, but it may not be as easy to access. And for some children, that may not be a problem, but for others, it might be. And so having a good plan in place for how you're going to access that property, how they're going to access income or value from that, those are critical components to making sure that your wealth transfer plan works like you want it to. So what are some of those tools or techniques that can be used from a planning viewpoint? Well, one, take a look at having a will or a revocable living trust. And while I could sit down and we could go through each of these as a topic, I think, again, probably it makes more sense, one, that if you really like more details on this, again, I'm not an attorney, nor do I give legal counsel, but with past experience, I can share with you maybe more one-on-one how some of these various tools work in conjunction with how that fits with your estate design, especially as you look at how it relates to the wealth management dashboard that we provide you. But understanding the difference between a will and a revocable living trust, and I actually am going to take a deeper dive on that here in a second. A generation skipping trust, as the name implies, you've given resources to the next generation, you're going to skip them and give more resources or additional resources to the generation after them. Dynasty trust, which means you can set it up so it goes multi-generation. A charitable gift annuity means that you can give assets to charities, but they don't receive the principal of the trust until after those who are receiving income no longer need it. Charitable remainder trust is a more fluid version, a more manageable version of that same charitable gift annuity. It just brings some other options to the table that the annuity does not. A donor advised fund Could be a charitable fund where you get to give and then not only pass on affluence to your children, but pass on influence as well. A donor advised fund where your children who want to be part of that donor advisement can be a really useful tool to pass on not just assets, but influence as well. And then irrevocable life insurance trusts can be ways to pass on assets to heirs income tax free, providing either assets or income or both. Those are just some of the tools, and there's more than that, that can be used to provide assets to heirs, provide income to heirs, to provide tax advantages to heirs, and make it so that you can accomplish the objectives you have, assuming that you've defined what those are, and in the plans you're putting together. So as you look at the people you're working with, the property you're dealing with, and the plans that you want to put together and the objectives of those plans, you're now well on your way to creating a very solid estate design or wealth transfer plan. Some additional tools to consider: durable power of attorney and letters of instruction. Durable power of attorney, it handles property management and healthcare decisions if you become incapacitated, or if you suffer from Alzheimer's or dementia, become incompetent and unable to make those decisions. They don't have to be the same person. They could be different people. You might have somebody in your family who's good with financial issues and somebody else who's good with personal or family issues. And you can have two different people, but it helps create a great planning resource for what happens in those end of life issues. And then letters of instruction for household goods or personal effects. You have a collection that somebody in the family wants. This is a chance to take this separately from the estate and give it directly to them. Maybe there's something that one of your family members really just is in love with, and that's a great opportunity to pass it on to them. And understand this: while it's true that families fight over all kinds of things in the estate transfer process, the reality is oftentimes the biggest fights are over the grandfather clock or the watch that dad used to wear. And having a letter of instruction in place that clearly defines what you're trying to pass on and the purpose of it, and making it so that all of the heirs understand why you're doing it, can save just a huge amount of discomfort and quite honestly, enmity between family members later on that I don't think any of us want to see happen. But unfortunately, I can tell you it does happen far more frequently than you realize. So having a durable power of attorney can help you with end of life issues before you pass, and having letters of instruction in place can take those really personal items and pass those to the people who want them and clearly identify what your goals and objectives were in that process. So you might say, well, Frank, I have a will, or it's an old will, but I haven't done anything with it, or maybe you don't even have a will. I will say that while I think that many of our clients do have wills as part of our regular conversation with them, I will say that I do talk to people who either A, don't have one, or it's so old that they know they need to get it updated, but they just haven't done that yet. I think it's probably because people just hate to deal with this issue, but it clearly is the last stewardship decision you and I get to make, and so we want to take it seriously. So what are some reasons that you should have a will, or you should update an old will? To revoke any previous wills, to waive any required bonds that might be forced on people because they don't have this document in place, to identify who your personal representatives are and identify your trustees, to implement your guardianship desires for minor children or for children with special needs, payment of your debts and expenses that has to be taken care of, as well as taxes also. Implement disposition of any personal property that you have, execute any fixed distributions of either assets or in some cases income that you want people to receive, execute any remainder distributions, what's left over after everything else has been decided, implement any decisions or powers that you've requested for the people that you want managing as your administrator or executor, to implement the trust exactly as you've requested for it to be set up, and in some cases even to identify your stewardship testimony. I've seen wills or estate transfer plans that have been set up where the parents clearly identified in a letter to the heirs what they wanted, what their purpose was, and what their testimony was, and gave them some understanding of what mom and dad had gone through. So these are reasons to have a will. If you don't have one or your will is old, these should motivate you to get something done, because if you don't have that and you pass away intestate, that means that the state makes decisions for you. and they don't make the decisions you might want them to make. I don't mean that they take the money themselves, but they divide up the money among heirs in a sort of standardized method that may not fit your family one bit. So having a will is you expressing your last stewardship desire and doing so in a way that meets the objectives you have for your family. So what does a basic wealth transfer plan look like? I mean, in terms of sort of a flow chart? Well, there's those 6 items I mentioned to you before. And if you have a will, what happens is your property is titled, coordinated with your will or power of attorney, and your power of attorney helps manage assets at disability. And when I say disability, that could be before you stop working or retire or redirect, or it could be after you're older and have incapacitation or incompetency issues. That durable power of attorney can step in and make it so somebody that you've chosen, somebody that you trust, can step in and help manage these assets until either A, you're better again, or B, you pass away. After that point in time, you have the will itself, and the will hopefully would have a letter of instruction attached to it, so it would then decide where you want everything to go. The will takes the majority of the items, the letters of instruction, take those very personal items and hand those to the people that you want to receive them. The will appoints a personal representative, and if you have minor children, you can't just hand them money, so a trust is required to take care of them, and you can choose a distribution process. And I just wrote down some ages there, age 25 or 30 or 35. You could pick and choose. You could say, once they turn 18, give it all to them. Or you might say, I want to wait till they're 25 or 30 or 35. Give it to them then. You might say, give them income before then. Or you might say, you know, at 35, give them a chunk of money, but then keep the rest and distribute income. The options you have really are wide and varied, and you can choose what you want. But once the minor children have been taken care of and everything else has been dealt with, then with no minor children in place, the rest of the estate is distributed out according to your will, and it goes to family and or charity if you have that intent, and it accomplishes your plans, your transfer at that point. That, at least in a flowchart model, is what that looks like. And having that in place, having it where you've written it out, worked with competent counsel to create that, is absolutely critical to you being able to choose exactly how you want things to go based on how you feel you're called to set things up, and based on how you know your family and your situation to look, to create the best model possible for those 4 Ps. Again, the people, the property, the plans, and the planners. So now, 4 estate costs to consider, because when we do this, those costs are there waiting for us to have to deal with them. So the first cost is estate taxes, and for most people, that's really not going to be an issue, because currently for estates in excess of $12 million, they would have tax issues. Under that, you don't have that problem. So chances are, majority of people you and I would meet are not going to have to deal with that. But there are some who do, and they have to plan wisely for that. State death taxes depends on the state that you're in, or if you have property in multi-states, that can certainly be a problem. But typically, if you don't have federal estate taxes, then you don't have state death taxes. But understanding that, looking at the various states you're working in, that you have property in, etc., would be important. Income taxes, you may never have thought of it, but the IRS does not let you, you're not finished until you've given them the dollars they require. And so with that final tax return, it actually comes in 2 ways. The first is keeping in mind with income with respect to decedent. And in Harry and Mary's example here, they had $1.9 million of income tax due off of retirement plans, qualified plans. And so while you might think, oh, it can't be that much money, it can be. See, here's the way it works. When you pass away, when I pass away, if we pass away in the middle of the year, we're going to have to file, or our state will, a 1040 income tax return, which will show the income that we made while we're still alive, and the IRS says, okay, we want that money. They don't simply go, well, you died that year, so we won't get any money. No, they get the money for what they're due for the time that you were on this planet. But if you have qualified plans that have never paid taxes, well, those would be expected to pay taxes. IRAs, savings bonds, pension plans, annuities, all items that are tax deferred, and that's really the key word there. The tax burden on them have been deferred to some later date. That later date is either going to be A, when you pull the money out, or B, when you pass away and it goes to the next generation. That's a 1041 income tax return. And the way it works is this. Let's say you had a $700,000 IRA that you had worked hard to build up. The IRS says, hey, you know what? 259,000 of that's ours, and we want it. Now, they might not take it all in the first in that year. Your heirs have the ability to spread that out over a few years, but they're still going to get their money. And so that $700,000 IRA that every month you look at your statement, you're like, ooh, I got 700,000. You really don't. You have about 260,000 less than that, which means your heirs are going to get about 441,000 in this little example. I would point out that if you're sitting there concerned about your spouse doesn't have to deal with this. This only happens at the second death. So if you're single, okay, your heirs will have to deal with this. If you're married, your spouse won't have to deal with this, but when your spouse passes away, the heirs will have to deal with it then. And one other point that I think is important to realize here is that while the IRS wants their income with respect to decedent, IRD, the reality is that wasn't the only tax they took from your IRA. Because the fact is, when you turn 72, the IRS has what's called an RMD, a required minimum distribution. And if you have not been pulling money out of your IRA before, then you now have to. And when I say you have to, I mean you absolutely have to. If you were supposed to pull $10,000 out of your IRA account and you did not, the IRS is going to say you owe us a penalty of 50%, 50, or $5,000. You were supposed to pull out 10, you didn't, give us 5, you keep 5. So you're required to pull this money out. Now, if you do the distribution, you're taxed at your regular rate, so you don't have to worry about that. So as long as you're doing your RMD. But when we do the calculations for our clients that show out 10, 15, 20 years into the future, what we find is that with their regular distributions and then their forced RMD, they have paid literally tens, in some cases, hundreds of thousands of dollars of taxes on that IRA. Plus, when they pass, there's going to be one more tax hit. And so planning wisely for that ahead of time is absolutely critical to make sure that you can pass more money on to your heirs and less money onto the IRS. In essence, disinherit the IRS. And that's part of the goal of a wise wealth transfer plan. There's another cost that most people are going to get hit with unless they have planned wisely, and that's probate fees. And probate fees represent additional costs such as attorney's fees, court costs, appraisals, advertising. National average is about 5 to 10% of a gross estate. So on top of that, there is judicial disregard for family emotions. I don't know if you think it, but the courts really don't care that much about how people are feeling. So they just do what they're going to do, and they're going to do it the way they think they ought to. And a few may care, but it seems like most don't. Additionally, there's publicity. I don't know if you've ever noticed, but every once in a while you might see the story of somebody who's passed away and how their estate costs were millions of dollars. Well, the reason that information is available is because it's all public. When you have a will and it goes through the probate system, all that information is public, so anybody can go see it. So that means that even your heirs can go check it out. If they're not quite sure what's going on, they can go check it out that way. So it's public information. Long delays. Average probate process takes about 9 months, but many have taken much longer than that. And then finally, if you have out-of-state property, there can be additional probates for other out-of-state pieces of property or assets that you have. All of those together can represent a huge amount of money added up. As a matter of fact, in the example you just saw a moment ago with Harry and Mary Arm, that was quite a chunk for them as well. So what's the difference then of having a will versus a trust? And I realize this is probably too small for you to see, but this identifies the benefits and costs of having a will. This identifies the benefits and costs of having a trust. I should have made that bigger, I think, now that I see it, but most time people see it sitting in the office. I apologize for that, but when you're in the office next time, I'll show you if you'd like to see it. But not having an estate plan or having an old or inefficient estate plan could double or triple the cost of transferring wealth to your loved ones. And so when we look at how to set this up properly, setting up a trust account, which encompasses your assets, can be a better process. One, it can avoid probate. And so by avoiding probate, it's going to help reduce that cost. Two, it's going to make it so it's not public anymore. So that information is private now. So those two items by themselves can be very helpful. And along with that, there is a process for how you can transfer more efficiently and faster as well. I do see the questions and the hands up. I would like to get through through this to the end if you can, so hang on to those, please, and I promise you will take time to answer them. So when you have your basic wealth transfer plan set up with a trust, you begin to change the process a bit. So for instance, your durable power of attorney kicks in and moves all the assets into the trust, or the appropriate assets into the trust, and then the trust takes over and starts identifying how actions are supposed to happen. Again, privately, not publicly. If you have assets are not held in the trust currently, a will roll those over. It's called a pour over will. It'll add those to the trust at the time of death, which again helps create that other process of less expense, more efficient, and privately held information. At the point of death, again, the same process happens. You have the trust set up. If you have minor children, again, the same process. They're no different. But once you have passed away, or I'm sorry, once there are no minor children left, then your letter of instruction kicks in. The assets then go to family and charity. And if it's done properly, it minimizes probate, it minimizes taxes, not because of the trust document itself, because of better planning with the wealth transfer plan, which we can talk about more at another time. But in this example here with Harry and Mary, if they had started doing some planning on those qualified plans much earlier, they could wipe out that $1.9 million of taxes, or at least significantly reduce that amount by looking at a Roth conversion, for instance, or by looking at how they hand it to charities, etc. There are various pieces there on how they can set this up to take care of their loved ones, to take care of the organizations they care about, and to disinherit the IRS simultaneously. By having their trust put in place, they wipe out that $870,000 of probate expense. So by doing those two items, they have saved somewhere upward end of 2.8 million, but maybe it's not that full amount. Maybe they can't wipe out all the taxes, but they have taken a significant chunk out of that, changing that amount to heirs to a much better number, going to the people they love and care about, assuming they don't really love and care about the IRS, the court systems, or the attorneys or whatever. By having that in place, it's a much better estate design process. And again, your wealth transfer, your wealth management dashboard illustrates this for you. We actually can put the information together and help you review that and then decide what would you like to do with that. So now we go on to the fourth part, which is still connected to tools and techniques, but now it's the planners. So we've looked at the people, we've looked at the property, we've looked at the plans, now we're looking at the planners. And seeking counsel is absolutely critical. Yes, if you have a small estate, and I'm going to challenge you to recognize that many of you are like, oh, I've got a small estate. No, you don't. No, you don't. I can't tell you how many times people say to me, I didn't know I had that much when we do their wealth, their financial plan. They never really understood the costs and fees associated with some of the various things they're doing. So I would encourage you to gather up all your information to recognize whether you do or do not have a little. But even if you manage a little wisely, then you are in a position to manage more later. So seeking good counsel from financial planners, attorneys, accountants, investment advisors, life insurance agents where appropriate, realtors, business brokers where appropriate, and trust officers where appropriate. Those people can help take that plan and put it into action. And well, I'm going to say this, I'm going to hit one other point, but I'm going to say that for the next section. Because communication is the key, which brings me to the last part, decision number 6, the talk. So we talked about now the 6 decisions. What am I going to transfer? What's the treatment of how I'm going to transfer it? What's the timing of what I have to transfer? What's the titling of that property now? What tools and techniques should I be using? And now the talk. Because the talk may be the most important part of this. The others are critical, don't misunderstand, but this may be the thing that helps your family stay connected and even grow stronger in the process. Communication is the key. First item, to plan, implement, manage, and review your wealth transfer plan on a regular basis. That's you, and if you're married, your spouse, and if you have a couple of your children really seriously involved with this with them, that's absolutely critical. And what's a regular basis? Well, for some of you, it might be yearly. For others, it might be every couple of years, but at least a regular basis, especially if things are changing around you. You have a big family, you have grandchildren coming in, you have great-grandchildren coming in. It's probably wise to update everybody to make sure everybody's on the same page, because that brings me to number 2. Be open to involving your beneficiaries in the process because it's beneficial to all involved. See, the thing is this: if you've got some difficult family members, I'm sure you don't, everybody else has difficult family members, but if you have some difficult family members, even though it would be difficult for you to explain to them why you've chosen to set their portion of the estate up this way for a distribution for a lifetime, or you're going to give this asset to this person, etc. Even though that'd be difficult for you to do it, your heirs are going to go away disappointed. Those beneficiaries are going to go away disappointed. But it's much better to have them disappointed with you than to have them disappointed with their siblings. And I'll tell you why. So oftentimes what will happen is people will be setting up their wealth transfer plan. They'll have their estate design, their will, their trust, whatever. And they'll say, well, this child is closer, they're in proximity to me, they live closer to me, or this child's better with handling money than the other, so I want them to help set this up. And the problem with that is you put those children on opposite sides of the table. I'll give you this example. So you have a child that comes to you and says, hey, I'd like to get $20,000 from you. They tell you why. They've got some great, awesome plan they want to do, and they tell you about it, and you're like, no, we're not doing that. Well, they go away, they're disappointed. They might even be angry, but at some level, they get it because it's your money. Now take that same exact story and move it. You've passed away, now your heirs, your children, that child that you put in charge is now dealing with it. That child who came and said, hey, I need this $20,000. They come to that child and they're like, hey, I need this. And the child gives exactly, their sibling gives exactly the same answers you gave and has the exact same reasoning, everything that you would have said. The child who wants the $20,000 now goes away angry because when it was you who said no, they got the point that this was your money and you could say no. But when that sibling tells them no, they're keeping them from their money. And at that point, it's a very hard process to overcome. This is where having a trust officer in place, somebody that all the children can be sitting on the same side of the table. And when the trust officer folds their arms and says, no, we're not doing that because this is the way the trust is written, the child who's angry because they can't get the 20,000 turns to their siblings and says, that's not fair. And the siblings are like, yeah, I know, it's terrible. But now they don't have to fight about it. And that's why you having the talk ahead of time can help make that a better transition process down the road for all of the heirs. Number 3, involving your beneficiaries now will give you insight into which stewards are best prepared and which stewards could benefit from assistance. You may remember last month when I did the update, I told you you should be doing your giving while you're living so you're knowing where it's going. And that's what that means right there. If by giving somebody $10,000 today and you watch how they handle it, it's either going to strengthen your confidence that they are really ready for this, or it's going to identify unwarranted confidence that they're not really ready for it and help you identify how to handle this better with them. Maybe have a conversation with them, or maybe if you don't feel like you can have the conversation because they just won't hear you, then you adjust the estate so it better manages everything for their benefit. Communication is the key, and that requires a family conference. The family conference is where you have that a place where you sit down. Now again, maybe when you're reviewing your plan, it's just you and your spouse, and maybe if you have a couple of key children involved in the discussion, you involved in that part. But when it comes to the whole, talking to everybody, all the beneficiaries, that's everybody. This is where the family conference comes in. Why? 1, to avoid creating disunity and promoting family harmony. Even if it doesn't create it while you're having the conference or even shortly afterwards, it will be better long term. 2, train the next generation wisely with values, goals, and priorities. 3, educate the next generation about tax law, investment principles, wealth management strategies, because they don't always understand what you had to deal with. And then 4, to intelligently transfer stewardship because assets cannot be controlled beyond the grave. Again, don't set up a trust because of lack of trust. Set up a trust to manage wisely for the benefit of your beneficiaries. And you can't manage it from the grave, but you can certainly set up a good process to make sure it works out well for everybody involved. When you do this, at least annually, Again, I said a moment ago, you do biannually. It kind of depends on the complexities of your estate, but annually or whenever necessary, depending upon your wealth transfer plan and changes you make. Who should attend? All involved adult family members, not the kidlets, not the grandkidlets. You don't, no, this is just for the adult family members who would be impacted by this. The agenda should utilize a formal agenda to create or facilitate a successful family conference. Everybody has an agenda in front of them. Everybody understands what's going to be talked about. And the challenges you're going to find, provision versus protection. You know, they're going to have ideas of what they want, but you're the steward. You get to decide how this goes because you have a higher view. You've seen more, you know more. You need to guide them in the right way. Provision versus protection. You're trying to set up some things to protect everybody, whether it's from the 4Ds or it's from taxes or it's from other challenges they may face, even some internal. You're trying to create the best model of provision and protection for them. You want to have this, do it earlier rather than later, so it minimizes strife among the children. You want to also look at issues, how it's going to care for elderly parents. Now, you might be the elderly parents, but having that process in place before you can no longer have this explanation is critical to make sure that when you are at those end of life issues, you've got everything set up properly. And then the other challenge can be, and sometimes maybe you're the one with the wealth, but your parents don't have wealth and you're trying to involve them in the conversation as well. Sometimes adult children of parents who don't want to talk about these issues. Maybe you've got parents who you'd really like to get involved in this conversation because they have wealth and you know that everybody could benefit from this. If you can get them involved, that certainly is going to be a challenge, but if you can, it makes everything better in the end. So the wealth transfer planning questions, 4 questions to consider before creating your wealth plan, your wealth transfer plan. 1, who owns this wealth now and who should own it in the future? And that question can be asked in multiple different ways, but definitely needs to be considered from a stewardship perspective. 2, what do I feel called to do with this wealth? What do you feel like you're supposed to be doing with it? Remember, we talk about return on life. What are you supposed to do with this so you get the maximum return on life? How much is enough income or wealth for the next steward? What is necessary? Oh goodness, I'm over time already, sorry about that. How much is enough income or wealth for the next steward? You don't want to give your children so much that it hurts them. You want to give them enough that it matches what their lifestyle is and doesn't take away their desire to grow. And then finally, question number 4, is the next steward prepared? Are they ready to go with this? Can they manage as they're supposed to? And have you given every opportunity for them to get that way? Because that will determine how you should set up your wealth transfer plan and their particular piece of it. I started off with this very question on our last webinar, the difference between estate planning and wealth transfer planning. I didn't have any real opportunity to dive into incapacitation or incompetency, but I would tell you those are very critical issues to this. Your wealth transfer plan can do a much better job of dealing with end-of-life issues than, say, a regular estate plan. And then certainly it can help immeasurably with death issues and that transfer at the time of your passing. So I'm going to take a minute for questions here in a second, but just as a quick reminder, on our website now, we have all 4 of our applications set up so you can go to them. All you got to do when you go to the website is go right up here to the login button, hit login, it brings up these 4. This is your wealth management dashboard, which is what I was using to show those calculations a moment ago. This is your investment management dashboard, which for the investments you have with us, it actually shows performance, rates of return, identifies diversification and so on, but with what we're doing, managing directly. This will help you with indirectly, this will help you with directly. Your risk reward evaluation, identifying your assessment, how much risk tolerance you have, and then your financial life plan, which is, for those of you using it, it is the best, it's the bomb, because what it does is it helps identify the feelings with the facts and create that return on life you want. What life transitions are you facing right now? What life goals you want to make sure you accomplish? It helps take and bring life to the numbers. These are all available to you and they can be used to help you with that process. All right, now I'm going to do the questions. I'm about, what am I? So sorry, I'm about 5 minutes over. All right, let's see here what we're doing with questions. So the question was, does a revocable trust count as a trust? It does count as a trust, no doubt about it. It absolutely counts as a trust. It is a different type of trust. There are various issues to trust, and if I had more time, I'd go through them with you, but But Anuj, I'll be happy to do that with you. There are issues of revocable, irrevocable, funding it now or funding it at death, various aspects to determine which type of trust you should use, because not all trusts are created equal. Each has pluses and minuses to them. You want to choose the right trust document for you. Again, I don't want to get off into the attorney territory. I don't give legal counsel, but I can at least answer on a conversational basis of those various points for you. But yes, a revocable living trust does count as a trust, and there's other aspects that it may be helpful with, but others it may not. All right, I don't see any other hands going up or any other questions, but I'll watch before I shut this thing down. So just as a quick reminder for the next investor update, that is going to be September 27th, which is actually a Thursday. I'm at an investor advisor, or I think it's a wealth management conference, and I will not be back on Tuesday. It'll be too difficult to do the workshop from where I'm at this time. So we're going to move it to Thursday night. So be aware of that. September 27th on a Thursday night, we'll send you out a reminder for that as well. So if you turn on the third Tuesday of the month, you'll be like, where's Frank? Well, just 2 days later is when I'll be talking. So you can join me then. So here's what we've covered. Market and economic review. I probably had a little more time if I would like to have gone into some of the detail on that, but I'll spend more time on the market and economic review next month, especially in light of, I think, what new information we'll have. And again, portfolio management diversification considerations, we covered that, but if you'd like to talk more specifically, please feel free to reach out to me. I'd be happy to go over that with you. Hopefully now, as looking at the power of wealth transfer planning, you have some new ideas on how to deal with this in the best way possible when it comes to the 4 Ps and the 6 decisions you have to make in that. Hopefully the wealth management apps, you're using them, and if not, please reach out. We'd love to help you use them because they are very powerful. Your questions, I answered the one. I thought we were gonna have more, but hey, we're here for you, and so I'll be happy to answer those. Even if you have emails or whatever, we can certainly talk again about that. And then please remember, the next investor update is not on Tuesday, it's on Thursday, and we'll send out a reminder for that as well. If you would like to invite your friends to join this, we are more than happy to accommodate that. Just email Kayla, that's Kayla@franksoffice.com, and she'll be happy to get an invite to your friend, because they can't come in unless they have the invite. It's just, that's how they got to get into this meeting. So please let us know or let them know, and be happy to get that to you. So I am a little over. I apologize for being over. I try to get this done, but this brings us to the end of tonight. I really enjoyed sharing the information. I hope you got something valuable out of it. Until though, next time, I just hope you have an enjoyable journey, and that your destination meets all of your desires. And I will look forward to seeing you on our next investor update if I don't talk to you before then. Have a great night. Bye-bye.